In many corporate environments, financial records are still managed as static, historical blocks. But as global data volumes increase, these rigid structures are being shattered by the velocity of modern automated pipelines. Checking random invoice samples or relying on manual reconciliations cannot keep pace with these streams. In a high-velocity environment, traditional audit methodologies are structurally obsolete. Financial enforcement agencies have recognized this technical gap. They have moved away from waiting for end-of-year disclosures and are shifting toward real-time oversight. Regulators now mandate direct, continuous API-level access to corporate financial data pipelines to ensure they can see transactions as they happen. Standard compliance checks fail to detect the specific risks of this era: automated margin manipulation and synthetic invoice fraud executed at machine scale. To address these risks, enforcement agencies have deployed a specific protocol known as the Algorithmic Sandbox. Regulators use this protocol as an automated enforcement mechanism, interrogating live data rather than waiting for the manual upload of static reports. The sandbox utilizes machine learning protocols to scan corporate ledgers for anomalies around the clock. Its primary directive is to identify unvetted autonomous tools and machine logic operating within the general ledger. For the modern enterprise, running unexplained AI models within the financial architecture creates an immediate and severe compliance liability. The regulatory sandbox functions as a secure parallel compute environment. Instead of merely verifying that the math in a report is correct, the sandbox backtests the organization's entire operational history to ensure consistency. The environment ingests raw data streams, isolating automated forecasting models and automation loops. It subjects these nodes to rapid-fire variables to test mathematical stability. Executing hundreds of synthetic stress tests, the system isolates accounting nodes, flagging hidden code shifts indicating manipulation. The regulatory AI then cross-references these against a massive historical baseline to detect minute data drift. These predictive anomalies are often invisible to human auditors and traditional manual oversight teams. This environment is designed to catch algorithmic deception before it can influence public market valuations or financial disclosures. Modern CFOs face a significant internal liability: the use of shadow AI within accounting departments. Analysts seeking to meet deadlines may plug sensitive corporate ledgers into unvetted public language models. These models are often used to draft variance commentary or accelerate the month-end close without formal oversight. This practice leaks proprietary financial architecture and general ledger data into public data pools. This diagram illustrates a catastrophic threat: a bridge between a secure corporate ledger and an unsecured public network, allowing machine-to-machine errors to enter. An unvetted plugin introduces a singular logic bias into a core function, like inventory valuation. This error geometrically duplicates, compounding across millions of rows of downstream data. When the algorithmic sandbox detects this compounding variation, it flags the system for systemic corporate fraud. To survive this level of automated inspection, enterprises must implement 3 specific architectural defenses. The first is the establishment of a sovereign internal finance sandbox. In this architecture, a walled-off sovereign sandbox is built adjacent to the main ERP. No autonomous AI or third-party script may interface directly with live banking rails or the primary ledger. All predictive tools are quarantined within this internal environment for testing. Models must prove stability over 3 close cycles before being granted write access to the live ledger. This quarantine prevents untested machine logic from corrupting the core financial system. The second defense is the implementation of an AI assurance and provenance framework. During an audit, claiming that a model was responsible for a specific figure will result in immediate regulatory penalties. Enterprises must build an immutable provenance log beneath the ERP system to ensure transparent machine action. Within this framework, every data input and model adjustment is permanently recorded. If an algorithm adjusts a cash reserve, the human team can trace the exact logic pathway used to arrive at that figure. In an automated audit, mathematical explainability serves as the enterprise's primary legal shield. The third defense requires re-engineering the finance team into AI governance orchestrators. Manual data entry is no longer a viable role. It has become an operational liability. Teams must move away from spreadsheet data wrangling and toward high-level oversight. Human hours should be focused on governance, exception handling, and auditing the prompts used by the digital workforce. The value of the modern accountant lies in overseeing the machine that processes the data, rather than sourcing the data themselves. Regulatory inspection cycles no longer rely on human spot checks. They now rely on continuous, unblinking machine surveillance. Even accurate financial outputs are insufficient if the internal process cannot be mathematically verified by an auditor. A complete architecture, integrating the internal sandbox, the provenance log, and human governance, prepares the enterprise for the regulatory scan. In a properly governed system, the data pathways are traceable and the models are verified, allowing the architecture to withstand the sandbox inspection. Systems that rely on shadow AI or unvetted tools will fail these stress tests, leading to immediate corporate liability. Strategy for leadership must prioritize a clean data core and the lockdown of all internal sandboxes. Protecting the ledger in this new landscape requires an active algorithmic defense.